want to welcome GreenProfit Solutions President Joe Winn here with me today, as well as he's also known as the Credit Union Geek. Welcome, Joe. Tell us a little bit about yourself and your businesses.
Hi, thanks for having me. Well, once again, as Sarah mentioned, I'm Joe Winn. I'm the president of GreenProfit Solutions. We work with credit unions on a range of services, typically focused on revenue growth through non-punitive strategies, essentially creating value and building relationships with members. And also I write and speak and do lots of tweets and things as Credit Union Geek. Essentially, same idea, but with lots of references that you probably missed.
You can't deny the Credit Union Geek when it's St. Patrick's Day. You're wearing not only a green shirt, but a green Star Wars shirt. There you go. So one of the reasons, I mean, your article under the Credit Union Geek pen name had me reach out to you because I was thinking about how to address the Silicon Valley Bank issue, but also because your brand has really been built on ethical behavior, like you said, value add versus punitive fees, mission driven, you have a mission driven toolkit, so lots of very credit union-y, very ethical kind of things that your business is doing, and that's because that comes from you and your partners, belief in the system and belief in being decent business people. So that's sad. As we talk about,
I didn't know that was something that was uncommon and or unusual. I would hope to think that that's the standard.
You would think, but there are people out there who aren't trying to build the It's a Wonderful Life business, Some people think that's antiquated, but I think it's
does relate
so
directly
relevant.
to this.
It does. It's so relevant today, especially as we're talking about Silicon Valley Bank, because there's so many poor decisions, bad actors in this whole situation. Right now, I'm just going to mention the executives who are pulling out funds right before they knew the bank was going down. There were a lot of things going wrong. I mean, auditors, FDIC, whoever, missed the boat, or, in some cases you hear of auditors who are just taken to a steak dinner, never really dig into anything. And so some of the things that, on an ethical side of the business were not happening. And I just, what are your thoughts on Silicon Valley Bank and how just basic ethical business could have helped?
Yeah. I mean, it's pretty obvious, I think, right off the bat that these guys don't operate at all like the credit unions that we know and the family of banking institutions that we're familiar with, whether it be the thousands of credit unions that you and I interact with, or even the community banks that are in that same world. This is not that. Like, these are institutions, and the membership, I guess, the customer base of it, they're there for money. And I mean, these are major investors with billions of dollars in holdings that are looking to make lots of money very quickly. And then these are also people who are very excited about getting lots of money and looking to spend it very quickly. And none of this fits into the, hey, we're helping somebody get a leg up, in a challenging time or anything like that. I mean, this is like, when we talk community financial institution, they're on the other end of that spectrum. That doesn't necessarily mean they're bad. It just means that's not what they have as their primary goal. And we probably, from a regulatory standpoint and from just a common sense standpoint, we need to watch them and watch institutions like that so that we can make sure that they don't bring things down, because they have an outsized impact, as we've seen, on an entire market, because it's not just somebody with $1,000 or somebody with $15,000. I mean, these are people, what was it, 90 something, 93% or more, that was over the $250,000 deposit limit.
Up to $1 billion, apparently. Somebody
these are not like hey, I'm gonna pull some funds out for a coffee or something. This is like, hey, we need to buy that building, invent this new technology that may or may not change the world, and we got to do it in 6 months. I mean, this is a very different world completely. And you some of it, and not so much the Silicon Valley side, but the signature bank side on the other end, which coincidentally maybe uh, faced a similar fate, had some of that crypto bro activity, which I mean, look, the ideas behind cryptocurrency, the Bitcoin, the technology behind it will probably change the world, but probably not through these guys. And they it, the whole concept that you mentioned ethics, and their whole thing is not having government intrusion, government involvement in money. They want to create a monetary system that's independent of all of that. Well, as soon as they ran into a major problem, their first call was, hey, government, can you help us out? And it's like, okay.
Yeah, and at that point is large enough a problem that, the government kind of had to step in. And no, you're not going to probably see that for credit unions because you're not talking hundreds of billions of dollars in one shot.
Yeah,
Yeah.
exactly. The definition of systemic becomes pretty apparent there. Whereas, you have a credit union that for some reason hypothetically made very poor decisions for a long time and is a $500 million institution. Uh, I mean, you'll see some coverage, but I don't think you would have the force of the federal government stepping in with the president coming out and speaking on it.
I also wonder too, sometimes when they come out like that, and then other people, like I'm on the board of my credit union, you start hearing from members. We didn't hear a lot because I think people know the difference. But yeah, you just start hearing from people who are concerned about, there's a run on this bank. Should we be, where is it systemic? And then when the Fed comes out and says, oh, we're going to give you all this liquidity, and the president's speaking to it, it's like, are they creating more crisis
Right,
rather
right.
than calming nerves? But
Well, yeah.
go ahead.
No, you bring up a good point. I mean, there's obviously the difference between that's FDIC and NCUA. I mean, those are two separate entities entirely. But then there's also the thing that, as you know, and you mentioned It's a Wonderful Life a bit earlier while we were chatting. I mean, the safety of the financial system and stability of it is partially based on everybody believing that there's safety and stability in the financial system. Like if everybody thinks it's a mess, I gotta go, then everybody pulls their money and the system collapses. Like we have to trust that the system is okay and working.
I mean,
And
the fundamental banking is It's a Wonderful Life, like
yeah,
we put our money in the bank and it goes into Joe's house and it goes into Sarah's car. I mean, it's a little different nowadays than It's a
I
Wonderful
mean, if
Life,
only it
but
really did work that way
the
still, but
principle is there. And I think you made a point earlier too, that, about the venture capitalists. One, they are not known not to be greedy. Just saying.
a good use of
I
double negative there.
Yeah, I know. I hope you. I'm glad you appreciated that. But they're looking for their quarterly returns, and not only that, they were requiring some of the companies they're investing in to put their money and get a line of credit and put their money into Silicon Valley Bank. And then Silicon Valley Bank was also requiring deposits if they were giving a loan, which I mean, they're securitizing the loan a bit. I get that, even though people theoretically there couldn't have been a run on the bank if that were the situation.
Yeah.
But you know, there prior to the housing crisis, there was the Glass-Steagall Act, which separated commercial and investment banking. And I think there was good intent in removing that, but we also have seen now the housing crisis, now this situation, where maybe it could have helped at least curb the impact of what was going on. One of the things I wanted to ask you about too is, so this bank was very much into environmental investing and lending, seemed to be following like this ESG risk model, the environmental, social, and governance. Kind of short on the G there, but
Yeah, I mean, I'm no expert in that, but I'm betting our friends over at like Clean Energy Credit Union would strongly disagree.
mhm. Yeah, I mean, especially when none of your board has any banking experience. But they had their butts covered because they're all Obama administration people. Anyway, but as far
They
as
never stayed at a Holiday Inn Express.
no, probably not. Um, so anyway, though, you are huge in the environment and marine biologist, all that. And do you worry that this will sour lenders and investors from environmental issues, from social issues, like we were talking earlier? It's not just about making the world a cleaner environmental place, but also just doing good in the communities. And is this going to make people shy away from investing and lending?
I mean, that's a great question. And I think that almost a benefit of the way everything's been reported is that I don't think the average person has a clue of that. I
Mm,
don't think the average person knows. They just like, oh, so Environment Bank, they had a whole bunch of giant companies, a lot of money, and then they messed it all up. And I mean, the whole premise behind good environmental work, environmental investment, is that you're supporting a community. I mean, yes, you may be propping up and building new companies for new technologies and processes and things, working with government and different agencies on that because they're major funders from National Science Foundation, even to DARPA and ARPA-E and everything. But I mean, at the core, environmental work and environmental investments typically are going to help people, like they're for community. I mean, we sit strongly on the idea of the old triple bottom line, which originally was people, planet, and profit, but it was better redefined into people, planet, and prosperity, which just kind of cleared up that, so it wasn't like mindless profit separated from it. But essentially, you're supporting the community, you're supporting the planet in some way, whatever that may be, from community gardens to carbon capture in a way that actually works. And from there, you're creating sustainable revenue to continue doing that and expand upon that. And I mean, that's the core of any good environmental work. I mean, that should be the core of it. And if it isn't, if your goal is only revenue and not the end goal of what the technology is claiming to achieve, then you're not really doing it.
right.
You
Yeah.
know, if that makes any sense. I mean, credit unions are very, very good at two of their categories of the triple bottom line. They're general, not too savvy on the environmental side, but they are people helping people. And they understand that you have to have community prosperity to do that and to continue being a financial institution that is able to serve them. So it's a very different world. And like I said, I don't think we have to worry too much about a souring on that. I think we have a bigger issue overall of VCs going, huh, where do we put our money and now what are we going to do? But yeah, I mean, the whole concept on VCs is just there. There's definitely going to be a change in how that's handled from their end, you know, from the venture capital and the companies. And obviously there's concerns on, well, yeah, they have their funds, but if they can't get credit, how do they meet payroll and this and that? And I mean, it's a knockdown effect, obviously, but it'll be more systemic into VC overall. And I mean, I think entrepreneurship should continue, and where they make sense should continue. But maybe this will be a good time to get a little reckoning on. It seems like every I don't know, 5, 10, 15 years we get into this state of like just pouring money into ideas that may not really be ideas yet. And, you know, and
Well,
then
innovation is creativity with an actual purpose and outcome, you know.
right, you know, I'm thinking of like .com time where it was like, I got an idea for a website. Cool. I registered the .com. Great, we'll give you money. It was like, yeah, but you don't have an idea yet. Like you just have a domain name. Uh, you know, we need to, I mean, I think that might tighten up what VC actually funds and say, all right, what is your idea? How is your idea work? A better breakdown of the money, because they're going to be a little tighter with it, because I don't know if they'll be so confident that they'll get bailed out again anyway.
Yeah, and so one of the things I want to ask you about too is, somebody kind of struck back at credit unions and community banks who were touting, hey, we're not like SVB, we're fine, we're great, and they are. But nobody was providing capital for these fintechs. Nobody was providing capital or loans, or putting a place for them to put their the capital they received from the venture capitalists. Banks and credit unions don't do a lot of that,
Right.
community banks. And so what are some ways that you see credit unions and banks being able to, maybe, obviously not overnight, but pick up some of that slack and take a little more risk?
Right. Oh, it's a good point. And you're right. I saw somebody snarked out on somebody on a credit union CEO's post on, hey, we're great. Like you said, hey, we didn't do that. And somebody's response was, cool. So you guys would handle my $40 million deposit for my company and manage the payroll and everything for it. And it was just like, yeah, I mean, these are different worlds. You're not you're not going in and saying, hey, I got a cool ice cream truck, and Haagen-Dazs goes, cool, bro. Like, that's neat. But we have hundreds of stores. Like, we're not the same world, even though we may have the same core product. Uh,
Mm,
and that's not to say that the ice cream truck is any less than that. It's just different. And that I did see that, and I don't know the details on the products. This was new to me also, but there are some insurance programs that exist that you can buy into, that credit unions can work with to enable insuring larger than the normal insured deposit amounts and whatnot, and handle some of those, in a sense, big net worth investment type business accounts. But I mean, overall, I think there's a huge issue, or a huge opportunity rather, for credit unions to take on regular, what we consider small business, which is still a hugely expansive definition in this country, but regular business lending, business accounts. I mean, it's not an area that's well optimized or well
mm.
used right now at the time. We typically, when we see credit unions buying banks, it's for their business accounts.
Mm-hmm. And why
You
are
know,
they, and with SVB, for example, why were they so heavily concentrated? Because others weren't doing the work, and this is an underserved market.
mm-hmm.
Now, not
Right.
everybody should be served, but, but
Yeah,
it
I
is
mean,
an
that's
underserved
outside
market.
our purview, but
um, so then, but I want to get back a little bit on the ethical side to the Fed, the FDIC's, the president's reaction to when you essentially throw the cap of deposit insurance out the window. At, I mean, in the scheme of things, a $200 billion bank ain't that huge. I mean,
right.
I mean, there have been systemic effects I've read about, but um, when you're throwing the deposit insurance cap out the window every time something big could be bigger, what kind of moral hazard is that creating, where if I'm a bank CEO or whatever, and my income is partly tied to the profitability of the bank, or the revenue of the bank, or however they want to tie their comp plan, then I'm going to do whatever I can to bump that up and not worry about it, because my butt's covered by the FDIC, or the NCUA, I suppose, if it were to happen that way. But yeah, I mean, talk a little bit about what you think of the moral hazard.
Yeah, I mean, you kind of went through most of it. I mean, that is pretty much the issue. I mean, I think the secret is just to sell all your stock a few weeks beforehand, and then you're fine.
You're
You don't have
fine.
to worry about anything. That seems to be the way to go. Uh, but seriously, for actual ethical institutions who care about more than just their own pocketbook in that case, um, yeah, there's definitely an issue of, does systemic does the word systemic essentially mean there's no insurance cap, uh, or depository insurance cap? Like, okay, what does that mean then? I mean, does that, like you said, does that mean that we'll just kind of do whatever we want? Because if we get big enough, then we'll get covered. Like, it's a bit of that too big to fail again. I mean, it's the
Yeah.
same thing with different terminology.
Yeah, I mean, if
And
you're gonna, I mean, I'll probably get hate mail for saying this, but if you're gonna raise the cap every time, there could be a big problem. And then at least the federal government should be taking their percentage like they do now for below the 250,000. Just take it for all of it. At least they're covered if something big bad happens. I mean, why pretend that you're only going to cover 250,000 per depositor? Just anyway, yeah, I guess that was more commentary, but you can say how brilliant it is.
yeah, no, Sarah is very brilliant and she has wonderful commentary.
Anyway, so any final thoughts, Joe, on any of it, the environmental piece, what cranes can do, um, anything at all.
Yeah.
St. Patrick's
I
Day.
mean, this is a time where credit unions had a chance to be in that conversation on risk, to discuss those topics, to bring it up with your members. And a lot of them I saw did the very standard thing. Your deposits are safe, everything's fine. We're insured under the NCUA, there's no issues, all that, which I get it. The whole concept of the financial system feeling stable is people believing the financial system is stable. So there's a lot of belief and vibe. And if everybody decided, like in It's a Wonderful Life, to go grab it all at once, it's not all there. It's like, Old Bailey sitting there going, look, your money isn't in the back. I can't make all of you whole right now. That's how the system works. But it does open opportunities for credit unions to also look at other areas of risk that they may have that may not take down the economy or the institution, but maybe it would make their members' lives a little better if you address that risk, or maybe it would guard you against pending regulatory discussions, something the CFPB is talking about, refunds, or what, I mean, they consider junk fees. Okay, not saying get rid of all of your fee structures, but start taking a good look at them and go, how can we replace some of this? Like, do we want to be caught up in punitive fees for all of our revenues, or for a big portion of our revenues? And I mean, this is the chance to do that now, and to look beyond just your regulatory environment. Like, okay, if you're state credit union, or if you're dealing with, even if you're a federal credit union, go, well, in our state, that's not an issue. If it's an issue in New York, it may be an issue with you because it may become a federal policy,
Right.
and
Well, and
yeah, it's just better to be ahead of that.
along the lines of auto lending, for example, right now people are concerned because credit unions have been making all these really low cost auto loans, which is giving them market share, which is great. But at the same time, these loans, not only are they underwater, excuse me, they're mismatched pricing, but they're also, especially the used car market, those loans are probably underwater because when people I bought a car a year ago, right? And it
Yeah.
is now worth way less than what I paid for it, because the prices were so jacked up after the coronavirus and the chip shortage and all that. So there's a lot of risk in there too. And I know you guys have some stuff that could help mitigate that risk.
Yeah, I mean, look, we've always been, I mean, and yes, full disclosure, in our company represents and offers programs on ancillary protection products for auto loans, but separately from selling the programs, because we haven't even mentioned the name of any of them, but separate from that, I mean, I'm a very good salesperson, very good.
When you won't mention the
But
name. Got it.
separately
Yeah.
from the very topic on it, are you protecting your members? And if you see that that's an issue, then you want to make sure that you're educating your staff, that you're educating your members on the importance of those products, and you have systems in place that make offering them or explaining them really simple and clear cut, so that you can potentially sell more of those. Not only do you make more revenue, but you're also protecting, because as we know, financial spirals get tighter and tighter as they go. You know, the penny in that little coin thing, that big old dome coin thing that you roll it around, it goes faster as it gets towards the bottom. In the same way that if you have one issue that crops up, you lose your job, or your car breaks and it's a very expensive fix, and in our car dependent society, that's the only way for you to get there. Now what? Now you can't afford the car fix, but you also are stuck not being able to get to your job in the same way. Now your finances start getting messed up on that. Things just barrel on top of each other, and that becomes a negative financial spiral. And that, as example, is something that could have been prevented immediately by a credit union well explaining the value of a protection product. There's a number of protection products on auto loans that would have covered those. You don't have to worry about paying the loan if you had some coverage on it. You wouldn't have to worry about dealing with the cost of a repair. Like, there's different things that are out there, and these aren't just things to make you money. And what you're talking about, the car is not worth as much. Well, there's the value on gap. I mean, if we know that a large portion of cars are not worth as much, then we need to make sure we're taking a very good look at offering things like gap that will cover those differences in case of, a car's totaled. We know car crashes are not going down. Put your phones down. If you're watching this in your car, put it down. And I mean, we have severe weather events that are on the increase. I mean, all these things that raise the chances of these types of things occurring. That's really where credit unions can go. And yes, if they want to get more involved with businesses, small business relationships, that's an opportunity as well. But it's keeping an eye on the core mission of credit unions. It's how can we help our people and our community in new and innovative and exciting ways, and in really boring ways. Like, you have to combine those,
like gap insurance.
Right, that's old and boring, but it's super important when you've just paid an $8,000 claim to somebody.
Mm-hmm.
That's a big difference for a lot of people.
Mm-hmm. Yeah, no, I mean, my daughter-in-law, she had totaled her car about a year after owning it. It was a used car, but a nice one. And yeah, if she didn't have that gap insurance, she still hadn't gotten to where she wasn't underwater yet. So yeah, she would have no car and have a payment still if that were, if she hadn't
which is literally the worst place to be. I mean, that just sucks. Like, your car is broken, it's gone, and you're still paying for it. And you still need another one.
Yep. Absolutely.
Credit unions can avoid that.
Yep.
And that's really where, again, like you were saying, that people and profit side, the people helping people, you're generating revenues, but you're also doing it by creating value and helping protect people. And I mean, I think that's literally where credit unions should always be.
Yep. I'm with you, man. 100%. Well, thank you, Joe. Appreciate it.
Thanks for having me.